Hello, very good morning to all, and I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be the Thursday, the 9th of January 2024. So as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this documentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap what has taken shape yesterday in terms of the intraday performance of the various broad-based cross-asset classes, the relevant news flow and economic data that drives this respective intraday performance before we jump straight into the intraday technical outlook for today on the key levels and the trend buyers on the major dollar pair, the major stock indices, and as well as the two key commodities market, Gold XAU/USD and West Texas crude oil. So let's start with yesterday's key economic data release. So yesterday we do have a kind of a tier 2 labor market data for US. So what you could see over here is that the ADP employment change actually came in weaker than expected. So market is expecting 140K, it came in at 122K. And what's interesting over here is that yesterday in the later part of the US session, we also saw the release of the prior FOMC minutes. I would say the minutes of the prior FOMC meeting in December. So the minutes actually indicate that in a nutshell, officials, Federal Reserve officials were eager to slow interest rate cut in 2025. So yes, we do see a slightly so-called lesser than expected ADP employment change data, but that hasn't kind of derail the market expectation of the Fed monetary policy stance in 2025, which is likely or highly likely to be less dovish as compared to last year. How do we see that? By looking at the CME Fed Watch 2, right? So if you look at the CME Fed Watch 2, based on the latest pricing of the market expectation from the movement of the US Federal Reserve Fed Funds futures market, excuse me, oh, man. Over here, if you look at the upcoming 29th of January FOMC meeting, market is still expecting a high chance that the Fed will stand pat, keeping the interest rate at 4.25% to 4.5% at a high chance of 95.2 chance, all right, over here. So there's actually almost a high chance that the Fed will not going to cut interest rate in the upcoming 29th of January FOMC meeting. And how about the other FOMC minutes down the road in 2025? So if you look at the aggregate tab over here, though this will showcase all the probability where the Fed Funds futures market expectation, then CME Fed Watch 2 will do the calculation all the way up to the 10th of December 2025 FOMC meeting. So what you could see over here is that market is almost looking for only potentially one to two interest rate cut only in 2025 after. So the next potential interest rate cut will come in likely in May, 7th of May 2025 meeting, where we have a higher chance of 50% at 63% chance to bring the Fed funds rate to 4% to 4.25%. Then thereafter, you see a slew of similar probability. So very likely they will start to stand pat again throughout June, the summer months, and potentially only cutting during the winter months of October and December this year. Roughly perhaps maybe in December, because it has a high chance of 65% based on the latest pricing of the FOMC, based on the latest pricing on as indicated by the CME Fed Watch 2. So net overall, the market expectation based on the Fed Funds futures market is only still looking for a potential at most 2 interest rate cut this year as we call it by the US Federal Reserve Bank, by the Fed. So that also translates potentially to a higher longer term 10-year US Treasury yield. So if you look at the longer term US Treasury yield over here, it continues to actually inch upwards yesterday. Right, inch upward yesterday. So net overall, the medium term trend still remain uptrend of the US 10-year Treasury yields still remains intact. So that also kind of support a stronger US dollar from a medium term perspective. If we were to look at the US dollar index as it continues to trend within this medium-term ascending channel from the low of 30th of September last year. Okay, and also holding above the 20-day and the 50-day moving average. RSI still remains supported by this rising ascending trend line support. No clear signs of a bearish divergence as well. As you see, the latest price action going to trend a higher high. Okay, from a technical perspective. So from a technical perspective and an intermarket perspective, it seems to us that the stances by the latest FOMC minutes indicating that the US Federal Reserve officials is more embarking on a less dovish stance for 2025 versus last year, and that sees the continued rise of the 10-year US Treasury yield, and with that continues to see the US dollar strength continues to trade within its medium-term uptrend phase as indicated by the daily chart of the US dollar index. And if you could look at yesterday's performance of the 5-day rolling performance of the US dollar against other major currency as we are speaking right now, so this should be 9th of January, yes, as we're speaking right now, the dollar remains actually strong against the sterling, the yuan, the Aussie dollar as well over here, as it continues to actually trend higher from a basis. So later I'll share with you what are the key short-term technical levels to watch out for on the dollar major pair thereafter. All right. So now in terms of the equity market performance, so equity market performance is rather lackluster yesterday. So almost unchanged in terms of the price action. So the weakest was the Russell 2000 over here. The Russell 2000 is actually down by negative 0.5%, whilst the SPX, the Nasdaq, and the Dow Jones Industrial Average is almost kind of flattish. So the SPX managed to gain, the S&P 500 managed to gain 0.16%, and the Nasdaq managed to gain 0.04%, and the Dow Jones Industrial Average 0.25%. So it's not really that a positive performance, it's more of a sideways range. So if you could look at the intraday performance of the SPX, so you see intraday is more like the sideways rangy formation as well, very similar for the Nasdaq and as well as the Dow Jones Industrial Average. All right. So one of the primary reason you see yesterday's lackluster or kind of a rangy sideways movement on the major US stock indices is more pertaining to today. The US stock market will be closed for a special day, not a public holiday, because a day of mourning for the former US President Carter is being mourned. So today, the New York Stock Exchange, let me expand my screen. Okay, so the New York Stock Exchange as well as the Nasdaq, the electronic exchange, will be closed for today, including the cash market and options trading on Thursday. So it's a national day of mourning for former US President Jimmy Carter. All right, so that's why due to the closure of today's cash market in the US, today's US stock market, that actually explained to us the lackluster or the sideways rangy movement that was seen on the major US stock indices yesterday. Right, something to take note of. And other economic data to take a look at is China inflation. So China inflation actually hit a 9-month low. So it was actually released at 9:30 a.m. Singapore time, right before the start of our daily dose. So what I could see over here is that China inflation on a year-on-year basis actually slid much lower to 0.1% year-on-year, came in within expectation as well. And also the PPI, the producer price index, also continues to sluggish at negative 2.3% year-on-year, or also within expectation of negative 2.3%. So net overall, what we could see over here is that if you look at the inflation rate in China, okay, give me a couple of minutes to actually pull up this chart for you guys to see. Okay, good. So if you look at the 5-year trend, okay, why is, yeah, so it's not showing the line graph, very strange. Why is it not showing the, yeah, this is the line graph. Okay, so what you could see over here is that it's since the high of Feb 0.7 in last February year on year, it started to trend lower with a series of lower high, and now it's actually going back down to the zero level mark. So very clearly, what you could see over here is that the Chinese economy is still facing this deflationary risk spiral headwind, and that also potentially causes the Chinese yuan to weaken against the dollar. So if you look at the Chinese yuan over here, okay, so if you look at the Chinese yuan, it continues to actually weaken against the dollars. That means the dollar is actually strengthening against the Chinese yuan. So actually, I use this is a CNH, the offshore yuan, that is much more we call it heavily traded than compared to the CNY. So the dollar CNH is actually showing a sign of continued medium term and medium-term uptrend as it goes to trend above the 20-day moving average. The next resistance level to watch will for sure will be the key major swing high area of 25th of October 2022 at 7.3750. So a breakout above this level, right, potentially sees the upper limit of this long-term circular ascending channel that is in place since 11 years ago, January 2014, with the next resistance coming in at 77.4120 next. So with a stronger dollar against the CNH, so one of the reasons why the CNH also needs to weaken, because the China we call it PBOC got to actually embark on a more looser monetary policy to actually kind of negate this ongoing China deflation risk spiral, and also due to this upcoming trade tariffs that could be inflicted by Trump's administration on China export towards US. They also need to weaken the Chinese yuan to make the China export maintain its competitiveness against the rest of the world. So if you look at how does the China stock market react to this, is what we could see over here is that the CSI 300 almost unchanged today, but the Hang Seng Index, yes, managed, even though it managed to gain slightly at 0.5%, but it's still hovering below a key short-term resistance level, which I'm going to highlight later on the short-term intraday technical outlook chart on the Hong Kong 33 next over here. All right, so that's kind of a sum up. Okay, one more news on share with you all is this ongoing frosty trade relationship between US and China. So before the new administration takes shape on 20th of January in the US, so the current Biden administration is looking to further limit NVIDIA AI chip exports over here towards some Gulf states and Southeast Asia country, and that definitely includes China as well, because we know that sometimes there will be a way of China bypassing it is by throwing a third-party country, all right, over here. So what we could see over here is that this ongoing high-tech war between US and China still remains pretty much intact, and potentially that tension will tend to get worsened if Trump's American First policy were to be enacted in full during his up and coming, we call it first 100 days. So we got to see how does the upcoming Trump administration were to continue with this, we call it China and US tech war. All right. So with that, that actually concludes the current important news flow, economic data release, and as well as the impact on the intraday performance on those broad-based cross asset classes. So now let us now jump straight into the intraday technical outlook for the broad-based cross asset classes. All right, so with that, let me expand my screen so that you guys could see. Right, so let us start with the FX market first. All right, so for the FX market over here, so let's start with the euro dollar. So as usual, the euro dollar plummeted within our expectation and hit our first support level and break through it at 1.03 20. Okay, so this was our former first support level, now turns into a first resistance level. So with the breakdown of 1.0320, I can now lower down my short-term pivotal resistance for today at 1.0380. So 1.0380 will be my short-term pivotal resistance level, a tightened one, to maintain that intraday bearish bias on the euro dollar. Next near-term support level to watch will be 1.0250. Only a breakdown below 1.0250 may expose 1.019 next. So that's actually the lower boundary of this minor descending channel from the high of 6th of December, and as well as a Fibo extension cluster as well at 1.0190. Only a push up with an hourly close above 1.0380, so breaking out above the upper limit of the channel, will negate today's intraday bearish bias to kickstart a kind of a minor mean reversion rebound again to retest 1.0420. Further above it, 1.0460 next. So i.e. in a nutshell, still maintaining that intraday bearish bias on the euro dollar using 1.0380 as my tightened short-term pivotal resistance for today. Now, turning our attention next will be the sterling dollar. The sterling dollar also plummeted and hit our first support level already at 1.23550. You could see over here. So with that, I could actually now tighten down my short-term pivotal resistance to 1.2480, which is the minor congestion area over here. We could see former minor swing low of 20th of December and former minor swing low of 8th of January yesterday. And if I do the Fibo retracement of this entire sell-off from last Tuesday all the way down to yesterday US session low, it also confluence with the golden ratio of 61.8%. We see over here. So net in a nutshell, still maintaining that intraday bearish bias. So yes, the hourly RSI has now exit from the oversold level, but there is no bullish divergence. The RSI also starts to shape a lower low in line with the price action. Yes, there could be some kind of bounce taking shape. So I will use this bounce to fade any strength using a tightened key short-term pivotal resistance level over here at 1.24880. That means during the European session, there could be a bit of minor bounce. As long as this minor bounce didn't surpass above 1.2480, using any strength to fade it to maintain that intraday bearish bias. Next near-term support level to watch out for will be 1.23 figure level / 1.2270. A breakdown below it exposes 1.22 figure level, which is a Fibo extension level of 1.236 as well. However, if price action starts to push up and shape a breakout with an hourly close above 1.2480, that would negate today's intraday bearish bias to see a continuation of a minor mean reversion rebound to revisit 1.25550, which is the 20-day moving average, and the minor swing high area of 7th of July. Only a breakout above 1.25550 could potentially validate an extension of the mean reversion rebound towards 1.26 figure level and potentially even 1.2670 next, which is the 50-day moving average, also acting as a resistance at 1.2670. So i.e. In a nutshell, I will use any potential strength to fade that rebound to maintain that intraday bearish bias on the sterling dollar using a tightened key short-term pivotal resistance for today at 1.2480. All right, now turning our attention next will be the Asia Pacific currency against the dollar, starting with the Aussie dollar. So the Aussie dollar continues to trade kind of sideways over here, still remaining below our first resistance level at 1.2660, which is the downward sloping 20-day moving average, and the upper limit of the pivotal resistance level, which is correspond to the medium-term descending channel upper limit as well from the high of 30th of September. So I will actually use a 63 figure 6320 as my short-term pivotal resistance zone. Still remains unchanged to maintain that intraday bearish bias on the Aussie dollar. A breakdown below the first intermediate support zone of 6180, 6160 may expose 6120 next. All right. Only a clear breakout of above 6320 will invalidate today's intraday bearish bias to kickstart a mean reversion rebound towards 6380 and potentially even 6430 next, which is a downward sloping 50-day moving average. Right, so net in a nutshell, no change on the key levels on the Aussie dollar, still remains the same as yesterday, using 63 figure 63.20 as my short-term pivotal resistance level to maintain that intraday bearish bias. Now, switching our attention lastly will be the dollar yen. So let's look at the dollar yen on the daily chart first. So on the daily chart, the dollar yen hit our resistance level at 15835 level over here. And what's interesting, yesterday it hit the hourly RSI has now starts to trace out a bearish divergence over here. There's a bearish divergence, as you could see, consecutive three lower high. Okay, three lower high over here, whilst the price action starts to shape a higher high. All right, so with this daily chart showing that bearish divergence on the daily RSI, so indicating that the push up since last 20th of December is losing momentum, and it really hit our resistance at 15835. All right, so given that there could be some signs of intraday weakness on the dollar yen, so with that I'll be using slightly above 15835, which is at 15880 level. Okay, 15880, if we go back in time over here, okay, is correspond to the minor swing high of 16th of July, right? 16th of July, and as well as a Fibo, close to a Fibo extension level of 1.618 as well. So using 15880 as my short-term pivotal resistance level, we will flip to a intraday bearish bias to see a potential push down towards the minor range support level. So in fact, it seems to be trading inside this minor range since the low of 20th of December. First support level to watch for today on the intraday basis, 15670, that managed to survive on 2nd of January since the start of this year. A breakdown below it sees the lower limit of this minor range configuration at 15595, which is the rising 20-day moving average. Only an hourly close and a push up above 15880 short-term pivotal resistance will negate today's intraday bearish bias within this minor range configuration to see the continuation of the impulsive up move towards 15945, followed by 16030, which is the major risk level, where this 16030 previously invited MOF instruction to ask BOJ to intervene in the FX market to sell the dollar and buy the yen previously at 160.30. So with that, in a nutshell, we will flip to a intraday bearish bias because of the daily RSI flashing out that daily bearish divergence using 15880 short-term pivotal resistance, but we are taking things one step at a time, only looking for it to potentially slide down towards the lower limit of that sideways range, 15660, maximum 15595, which correspond to the rising 20-day moving average on the dollar yen. Okay, so that also sum up the intraday technical outlook on the major dollar pair. Now, turning our focus now will be the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 yesterday, it came down and almost hit our support level at 90,030, and now it intends to shape a bounce back up towards the first resistance level at 19,335. So still no change, still looking at 19,580 over here, 19,580 as my short-term pivotal resistance level. Maintain that intraday bearish bias, a breakdown below 19,020, 19,030 will be my next support level to watch. Only a breakdown below 19,030 exposes 18,460 next, which also correspond to the rising 20-day moving average. Only an hourly close with a push up above 19,580 will negate this intraday bearish bias to revisit the former minor swing high area of 27th of December that has been acting as a clear resistance level for now at 20,150 next. Right, so i.e. in a nutshell, still using 19,580 as my short-term pivotal resistance for today to maintain that intraday bearish bias on the Hong Kong 33, i.e. the Hang Seng Index. So on the Japan 225, still no change. It continues to trap within this sideways range configuration. So maintaining that neutrality stance on the Nikkei 225, i.e. the Japan 225. So neutral between 40,155 / 40,420 and 39,180 for now. Okay, now turning our attention will be the German 30. So the German 30 actually broke our short-term pivotal resistance yesterday. So initially we do have a bearish bias below the 20,360 level, looking for it to float down towards 20,000, but price action continues to push up higher, and the hourly RSI also managed to find some kind of support level at the 50 level mark as well. Okay, over here. Okay, so with that, we got to respect the current bullish price momentum as seen on the hourly chart of the German 30 and the German DAX. So using the first support level to watch will be yesterday's US session low at 20,250. Below it will be the 20-day moving average, which is also close to the minor swing low of 7th of January, 20,150. So I'll be using this slightly lower level, 20,150, because it corresponds to two different elements, the minor swing low of 7th of July and close to the 20-day moving average. So 20,150 will be my short-term pivotal support level for today. So as long as 20,150 short-term pivotal support holds, we will maintain that intraday bullish. We will actually flip to a intraday bullish bias, pardon me, for the German 30. First resistance zone to watch will be 20,460/20,520, where it managed to stall yesterday, and also it's the current all-time high area. A breakout above 20,520 sees the next resistance coming in at 20,650, which will correspond to this turquoise blue line here, which is the long-term ascending channel. If I go to the daily chart, okay, in fact, it's the major ascending channel from the low of 2 years ago, almost 2 years ago, at 29th of September 2022 over here. So let me go back to the hourly chart again. Okay, only a hourly close below 20,150 will invalidate today's intraday bullish bias to kickstart another round of mean reversion decline scenario, exposing the 20,000 next, which is the rising 50-day, which is exposing the 20,000 next, which is the minor ascending trend line from the low of 20th of December. Below it sees 19,840 next. All right, so i.e. in a nutshell, we'll be flipping to a intraday bullish bias on the German 30 using 20,150 as my short-term pivotal support level. Right, so now turning our attention will be the US major stock indices. So just to recall that today the major US stock exchange, the New York Stock Exchange, and as well as the Nasdaq exchange will be closed for a special day today, where they actually pay tribute, or National Day of Mourning for former US President Jimmy Carter. So with the closure of the US cash stock market, both on the New York Stock Exchange and as well as the Nasdaq exchange, market do expect lower liquidity here. So it will be more like a sideways range configuration, okay, for the US Wall Street 30 for today. So looking at the US Wall Street 30, will be still no change. It can't clearly break below the 42,490 level, and it start to bounce. So still using potentially could be a sideways range configuration, using the 43,160/43,350 as my short-term pivotal resistance to watch out for. Only a breakdown below 42,420 may expose the next near-term support level at 42,010 next. Only a push up and a clearance above 43,350 level will invalidate today's intraday bearish bias within this sideways range configuration to see a recovery scenario towards the next resistance at 43,720, followed by 43,960. Okay, lastly will be the Nasdaq 100. So the Nasdaq 100 also managed to float down and hit our first support level at 21,040 yesterday, before trading kind of a very tight sideways range configuration. So I don't want to tighten the key short-term pivotal resistance to be so tight at 21,350, still using the 20-day moving average, and as well as the upper limit of this minor descending channel that I drew from the minor swing high of 18th of December. 21,530 will still be my short-term pivotal resistance level. Only a breakdown below 21,040 for today may expose it towards the lower limit of this sideways range configuration that is in place since 20th of December, acting as the next near-term support level at 21,860/21,780. Only a clear bullish breakout above 21,530 will invalidate today's intraday bearish bias to see a squeeze up towards 21,730, followed by 21,890 next. All right, so that's also sum up the intraday technical outlook on the major stock indices. So now let us focus our attention to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, it continues to actually come break above the short-term pivotal resistance zone of 2,664, 2,674 over here. So with that, we'll still maintain that intraday bearish bias within this kind of sideways ascending triangle range configuration that is in place since the low of 14th of November over here. All right, so you're still using that upper limit. Let me push it up over here. 207674. Okay, still use 2674 as my short-term pivotal resistance level. Still maintain that intraday bearish bias on gold XAU/USD. First support level to watch out for today will be this congestion area here, which is close to the 20-day moving average at 2640. Okay, 2,640 over here. Below 2,640 exposes the minor swing low area of 6th of January, this Monday at 2,614. We also correspond to the lower limit of that minor ascending triangle range configuration. Only an hourly close above 2,674 will see a squeeze up for it to float upwards towards the upper limit of that minor ascending triangle range resistance, 2,690. First near term resistance, a breakout above it sees 2,716, 2,728 next. Right, so that's for gold XAU/USD, still maintaining that intraday bearish bias within this minor ascending triangle range configuration, using 2,674 as my short-term pivotal resistance for now. Now, moving on, next will be the West Texas crude oil. So for West Texas crude oil, what you could see over here is that it came down and hit our first support level at 73 figure, and right now attempting to shape a bounce, and with the hourly RSI coming close to the oversold level again. So now there could be some kind of bounce taking shape. So this bounce, I will use this bounce to fade any strength to maintain that intraday bearish bias on West Texas oil, using now a tightened key short-term pivotal resistance at 74.60. So what's this 74.60? If you do the Fibo retracement of yesterday's sell-off from its high all the way down to Asia session low today, is close to the golden ratio of 61.8% as well. So as long as this bounce didn't surpass above 74.60, I will use it to fade any strength to maintain that intraday bearish bias on West Texas crude oil. Breakdown below 73 figure level exposes 72 figure, followed by 71.30 next, which is the rising 20-day moving average, I think, as an intermediate support next. Only an hourly close above the tightened short-term pivotal resistance at 74.60 will invalidate today's intraday bearish bias to see a squeeze up to retest the 200-day moving average at 75.30/80. Only a breakout above 75.30/80 will see it floating upward higher to retest this gray line here. So this gray line is in fact the daily chart. If you look at the daily chart of that gray line, the gray line is in fact the upper limit of this major descending triangle range configuration that is in place since March low of 2023. So now it's actually acting as a next resistance at 7670/77 figure. So i.e. in a nutshell, we'll be using a tightened key short-term pivotal resistance for today at 74.60 on West Texas crude oil to maintain that intraday bearish bias. Okay, so before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So for today, what we could see over here is in the European session, it will be a very quiet session as well. Nothing important to take note of. And we do have before the start, at 10 p.m. So at 10 p.m. we do have a U.S. Federal Reserve official speaking, Fed Harker speech at 10 p.m. Then thereafter the U.S. session will be quiet with the closure of the major U.S. stock exchange, the New York Stock Exchange and the Nasdaq exchange over here. And after that, early Friday at 1:40 a.m. all the way up to 2:35 a.m. we do have 3 Federal Reserve officials speaking. Fed Banking, Fed Schumix, and Fed Bauman over here. And what we could see over here in early Asia session tomorrow at 7:30 a.m. Singapore time, we do have key Japan data, which is the Japanese household spending data for the month of November. All right. So with that, that sum up today's intraday, today's daily dose of market insights. And I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.